The profit and loss statement, also referred to as an income statement, is a report that I'm sure you're already very familiar with. Simply put, it shows your profit and loss over a period of time. Pretty obvious, right? When assessing their financial performance, most people just look at this number, the profit or loss. Looking solely at this number doesn't give you the full picture of your financial position. Your profit isn't actually an indicator of the financial success. Accordingly, I want you to look at a few items in between. A profit and loss statement is split into three main sections. We have revenue, direct costs, and operating expenses. Let's start from the top. Your revenue is all of the income generated in your business, in the form of sales. The revenue represents your company's ability to generate sales from the assets that your company leverages. For example, if you are a service-based business, you generate revenue by leveraging the labor and specialist knowledge of the people that you employ. If you are a product-based business, you leverage your product and brand to generate revenue to your business. Software businesses build software and leverage the end product that people then pay for. So when you think about your company's revenue, think about what assets your company leverages to generate sales. This is important because we want to truly understand the types of revenue your company produces. And that leads us to our next point. From an accounting perspective, revenue is just revenue, right? A lot of the time, I see founders and business owners classify all of their sales in one line item on their P&L. Now, the problem with that is that it doesn't tell you anything about what distinct channels are these sales from. Are those sales repeating in nature? You see, the truth is that most businesses will have multiple revenue streams. These revenue streams comprise of sales from different types of products and services or different sales channels. Each type of revenue stream should be distinguished in your profit and loss. Now, in addition to splitting revenue by type of sales channel, it's important to understand the predictability of these sales reoccurring into the future. Now, this is important to us to help us understand the predictability of sales and therefore your cash flow. Accordingly, each sales category should be further defined by recurring or non-recurring revenue. So to structure your revenue for decision-making purposes, my recommendations are as follows. Revenue should be split either by product type or sales channels. You then split recurring revenue separately from one-off revenue. You can edit your chart of accounts in your accounting system to reflect this. Let's look at this in a practical example. What we have here is a simple profit and loss statement for Move Formula, our case study business for this course. Now currently, this P&L doesn't tell us much of a story. So we have some work to do to restructure the chart of accounts. What I'm going to do is export this P&L into Google Sheets, where it's easier for me to show my point. Okay, let's start with revenue. So as you can see, all of the sales for this business is allocated into one line item on the P&L. So currently it doesn't tell us anything about the sales channels that these sales are being derived from, or how predictable they are. So what we're going to do is a little bit of work to restructure these chart of accounts. Now, because this is an e-commerce business, I'm really interested in understanding the sales channels this income is derived. Equally, I want to understand the recurring versus non-recurring nature of these sales. So we can further define our revenue by setting up new accounts in our chart of accounts to be more specific about our revenue. Now, don't worry about doing this right now because I'm going to demonstrate exactly how to do it within the homework. Now, let's compare the current chart of accounts to the new one by reviewing something I prepared earlier. Okay, so what we have here are sales that are split by sales channels, right? We have our B2B sales, which is our wholesale sales to other businesses. We have online sales, which is just kind of the one-off sales of the business. And then we have subscriptions. So this is recurring revenue to the company. Now, as you can see, to make this more meaningful, we've categorized which of these sales channels are recurring in nature. Now, again, this is really important for budgeting purposes because recurring revenue helps us understand the predictability of our cash flow. We can basically bank on these sales recurring in the future, which is super important for us to give us visibility and foresight. So overall, this new structured P&L tells us a lot more about what the types of products, the sales channels, and also what is recurring versus non-recurring in nature. The next section of our P&L is direct costs. Direct costs, also referred to as cost of sales, are all of the expenses that are attributable to the production of your product and service. Now, this typically includes the cost of materials, direct labor, shipping fees, merchant fees, basically all of the costs that are directly associated with selling your product. Now, it's critically important that you set up your P&L so that your direct costs are correctly accounted for. Now, it's not uncommon for me to find expenses that I can consider direct costs that are incorrectly categorized in your P&L. Now, the rule of thumb for understanding which expenses are direct costs is if they are variable in nature. Variable costs are expenses that change directly and proportionally to the changes in business activity level or volume. Examples of your direct costs include the cost of producing your product, and that's for product-based businesses, merchant fees or other online selling fees, fulfillment costs associated with delivering your products to your customers, hosting fees if you're a software business, and direct labor associated with producing your service. And that's assuming you're a service-based business. So you're probably wondering, Jason, why is it so important to get the direct costs correct? I mean, doesn't it all just flow down to your net profit? The reason why we do this is because we want to understand your gross profit. Now, this is by far the most important metric in your business. And yes, more important than sales, as we'll cover later in this course. Let's look at Move Formula again. A really common issue when I review the chart of accounts for a lot of companies is that the direct costs are not accurately classified in the P&L. Now, in order to help us make decisions from the numbers, it's critical that we get this allocation right. Again, as a rule of thumb, any costs that are variable in nature are direct costs. So when I refer to variable costs, I mean all of the costs that will increase as your sales volumes increase. For a product-based business like Move Formula, it's the cost of your products and all of the other direct costs associated with getting that product to customers, which includes the shipping fees, merchant fees, and all the other things that you pay to Stripe or Amazon. Now, in Move Formula's case, all of these expenses are currently classified as operating expenses. Now, as you can see, your revenue is the same as gross profit, which is wrong and something we need to fix. Now, after a bit of work, here's what the direct costs should look like. So now's how we have a correctly structured chart of accounts for cost of sales. Now, this example, again, is for a product-based business. If you're a service-based business, like an agency, consultancy, or law firm, for example, your cost of goods sold are the direct wages of your technical staff. This means that all the payroll costs of your revenue-generating employees are regarded as cost of sales. And that's because your product are the folks doing work for your customers. Accordingly, you need to reallocate the wages of these staff up to direct costs. Now, this is quite an unconventional method of accounting, but it is critical for service-based business models because, again, we want to understand the gross profit margins of your company. The next section of your profit and loss statement is operating expenses. Operating expenses are typically fixed costs like rent, insurance, utilities, and wages. Irrespective of the amount of sales your company does, these operating costs will always be fixed. If you correctly categorize your direct costs, as we explained earlier in the piece, the classification of operating costs will sort themselves out. So a lot of the time, there's no extra work we need to do here. Phew. So summing up, the profit and loss statement is critical to ensure your chart of accounts are correctly structured in your accounting system to reflect the nature of your revenue, direct costs, and operating costs of your business. And that leads us to your first piece of homework.